Past picks with David Burrows. We're looking at November 6th of last year. Interpipe, which we touched on earlier, up by a cool 39% almost. Now, again, the question is, are these as attractive now as they were, with maybe rates going up at some point?
We think that the long-term story for energy infrastructure is intact. You're going to get probably 8 to 10% dividend growth for the next 5 years. On Interpipe in particular, this is a necessary piece of the infrastructure for the oil sands in the west of Canada. And it would take, we think, a sustained period of very low energy prices for them to curtail their investment. They need the diluent to move bitumen through the pipeline, so they really need to have this. They have very long contracts. And so volume growth, we think, is going to continue to be really strong. Are they as attractive as they were a year ago? Probably more attractive if in a more stable environment. There's probably a bigger question mark today, given prices recently in crude. But this has been a strong performer. It's held up in price really well. I continue to like the stock, and we continue to like the sector.
It has held up pretty well, as we saw on the chart there. Let's look at the CI Financial. You got a modest gain here. Are you still pretty bullish here?
We really like the asset management business, outside of the fact that we're in the asset management business. The fact is that if we are in a secular bull market for equities, if money slowly is reallocated to the equity asset class, the companies that have done a good job managing money are likely to see more dollars come in the door. And CI has done a great job. In the very short run in Canada, there is a question mark around fees, because we're moving to this new era of fee transparency. I think there are people who are concerned that that will have an impact on the fees that these companies generate. CI has been generally a low-cost provider. They've been very in tune with consumers. I think that their returns have continued to be quite good. So we think that the stock market over the next year is likely to be quite strong. We think that asset growth is going to be pretty good. And I think that you're going to get paid pretty well as far as dividend goes along the way.
Another big winner for you was Walt Disney, up by about nearly 35%. You recommended this last November. It was sitting at $69 then. So just running on every cylinder here?
Yeah, so first of all, it's been our view that Canadian dollar probably continues to back off versus U.S., so we've looked at a lot of U.S. ideas. When the consumer has a little more money, the first thing they spend money on is travel and leisure, and Disney certainly plays into that theme. Their franchises in the movie business are exceedingly good, and there's a big pipeline of films continuing to come, and we talked about that a year ago at that time. So all of these things are in place, and with low energy prices, that's likely to continue to have consumers travel. And so I think Disney will continue to do extremely well. We continue to own all three of these positions.
Disney, CI Financial, Interpipe, those are past picks, and David still likes them, as he said. Let's take a break here, and then we'll come back with more of your questions for David Burrows.